There is a specific type of discourse that I need to put a name to before we go any further. You have seen it. You have probably shared it. It is the LinkedIn post that says that corporations only care about shareholders. It is the Twitter thread that says we need to end shareholder primacy. It is the comment section under every layoff announcement where someone types, "Thanks shareholders," like they have said something. There's a word for this. I read it in a Reddit comment recently, and I'm stealing it with zero apology. Sloppulism. Sloppulism is what happens when populist outrage gets run through an algorithm until it loses all of its bones. It's got the aesthetic of speaking truth to power. It sounds like it is about mechanism. It is not. It is vibes dressed up in vocabulary, and the shareholder discourse is the single richest vein of sloppulism currently running through the internet. And here's why it matters, because when you don't understand the actual mechanism, when you just know the villain but not know how the crime actually works, you cannot fix anything. You are just yelling. And the people doing the actual damage are counting on you to keep yelling at the wrong target while they keep operating the machine. So today we are going to fix that. We are going through 20, read that again, 20 myths about shareholders that are repeated constantly, confidently, and completely incorrectly. Some of them are technically defensible, but weaponized so far outside of their actual context that they have become functionally wrong. And some of them are things that people believe so deeply that they have never even thought to question them, which is bad. We are going to do all 20. Let us start with the foundational myth, the one that everything else is built on. Shareholders do not own the company. I know, it sounds insane. You're going to tell me that's the entire point of a share. Let me finish. A corporation is a distinct legal entity. It owns itself. It owns its assets, its IP, its inventory, its real estate. The corporation owns all of that, not you. You own a financial instrument that entitles you to certain defined limited rights, a residual claim on earnings if dividends are declared, and a vote on certain matters that scales to irrelevance unless you're holding 9 figures. That is it. That is the instrument. You cannot walk into Apple headquarters and demand anything. You cannot redirect operations. You cannot fire Tim Cook. A homeowner can knock down a wall in their own house. You cannot knock down anything. The ownership framing is doing enormous ideological work and is not supported by legal reality. You are a piece of paper. The company owns the company. Here is the thing about stock price. The company already got their money. The IPO happened. They cashed out. Everything happening on the secondary market after that point is just traders selling to other traders. The company is not a party to those transactions. They do not see a dollar of it. The only moments when stock price actually matters to a company are 1. Employee compensation tied to equity. 2. If they need to issue new stock, as in sell off parts of their own company to issue new shares. 3. Potential loan collateral. And 4, I'll add this one, if they want to use stock as currency in an acquisition. That is the complete list. When a CEO says we have to do this for the stock price about a decision that does not touch any of those 4 things, they are lying to you. They made a choice, and they're going to call it an obligation. Those are different things. Here's another question. Who exactly are these shareholders that everybody keeps invoking? Because I can name 15 different types of shareholders who want completely contradictory things. You've got common stockholders, well, they're last in line for everything. Preferred stockholders, different dividend structure, often no vote at all. Index funds, legally required to hold the stock, cannot exit. Pension funds with 30-year time horizons. Activist hedge funds with 18-month exit theses. Retail investors with 200 shares on Robinhood. Insiders with restricted stock and lockup periods. ESG funds nominally driven by values. Short sellers who have an economic interest that is literally the inverse of every other shareholder ever. A pension fund and a hedge fund are not the same constitution-y. They want opposite things. Calling them both shareholders and deriving a single coherent obligation from that is not analysis, it is magic. Maximize shareholder value. Which shareholder? Pick one. They will all tell you different things. Here is where it gets genuinely absurd. The largest shareholders in most major companies are BlackRock, Vanguard, and State Street, and almost all of what they hold is in index funds. Index funds cannot exit. If Apple is in the S&P 500, BlackRock holds Apple. That is it. The exit mechanism that is supposed to give shareholders leverage, sell the stock, punish the company, does not exist for the largest holders in the market. And if BlackRock actually tried to flex its voting weight on something contentious, the litigation exposure would make it not worth it. So you have the largest nominal owners in the history of financial markets, and they are functionally paralyzed. They are not investors. They are custodians of a tracking era. Their business is fee compression. They're not analyzing these companies, they are running a logistics operation. The shareholders with actual power are activist hedge funds, a tiny slice of the shareholder class running a specific leveraged bet with a board seat attached. When you say shareholder pressure, that is who you actually mean, and they are not representing shareholders broadly. They are executing a trade. Tell me if you've heard this before. Everybody sell your Tesla, sell your Microslop, sell your insert public company that has not issued new shares in a very long amount of time. I want you to think about something. If everybody sold their LeBron James rookie card, would LeBron James stop being LeBron James? No, obviously not. The card market and LeBron James are two separate things connected only by a name. LeBron does not care. LeBron does not know. His jump shot is unaffected by his rookie card price in the card market. Tesla, the company, is still making cars, still has factories, still has employees, regardless of what is happening on Robinhood. There is a buyer for every seller. You sell, someone else buys. The company sees none of it. You have not punished anyone, you have exited a position and handed it to a stranger. And at institutional scale, it's even worse. A position large enough to actually move the price has to be unwound carefully over time, or you crater your own exit price. You eat the loss that you are trying to inflict. The stock market is not a petition. Selling your stock is not a protest. It is a transaction. Now, I want to be precise about something, because everything I just said about selling stock price not punishing a company is true for large caps, for the companies that dominate every headline about shareholder primacy. For a microcap company, a penny stock, a small cap, a company with a thin float and limited institutional coverage, the math is completely different. Let's say you're a company with around $110 million in market cap, and you are an indie game publisher, and your name is Devolver Digital, and you're on the London Stock Exchange. When a $110 million company has a bad earnings call and a handful of institutional holders decide to exit, the float is thin enough that the selling pressure actually moves the price. Fast. Materially. And when your stock drops 40% in a week, suddenly your loan collateral is underwater, your equity compensation is worthless, your ability to issue new shares to fund operations is gone, and the acquisition you were planning just fell apart because the deal was structured in stock. At that scale, stock price is genuinely existential. The mechanisms are real. The pressure is real. The accountability is real. Which is the actual irony of the entire shareholder primacy discourse. The companies where shareholder pressure is a legitimate operating constraint, the small and microcap companies, the ones actually vulnerable to secondary market dynamics, are almost never the companies being discussed. Nobody's writing think pieces about fiduciary duty at a $60 million industrial supply company. The companies dominating every shareholder primacy conversation are Apple, Tesla, Google, companies so large that the entire mechanism is theoretical. BlackRock selling Apple is a rounding error. A pension fund exiting a microcap is a crisis. And due to how voting shares in Tesla work, the shareholders legally are basically forced to let Elon do whatever he wants. Class B and Class A shares. We have built an entire ideology around the wrong sample. We took the behavior at markets at the small end, where stock price genuinely matters and secondary market dynamics create real accountability, and tried to apply it as doctrines to companies where none of that actually functions. And then we let the big companies use that doctrine as cover, while the small companies it actually describes don't have the PR infrastructure to be part of the conversation. This one is load-bearing for the whole ideology, so I want to be precise. After the IPO, secondary market shareholders are not investing in the company. The company received capital exactly once, at issuance. Everything else is financial instrument trading between strangers on a secondary market that the company is not a party to. You buying Apple stock on Robinhood is not capital formation. You are buying a receipt from someone who bought it from someone who bought it from someone, going all the way back to the one moment the company actually touched that money. You are holding the sloppy seconds or thirds or fourths of a financial instrument. That is the actual description. Investor implies a capital relationship with the underlying enterprise that simply does not exist. Does Wizards of the Coast have a fiduciary duty to the person who just paid $400,000 for a PSA 10 Charizard? No. That is insane. Wizards got their money in 1999. Everything since then is a secondary market that they are not a party to. It is the same structure, just different vocabulary. This is the justification for why you hear shareholders get priority. They took the risk. They should get the reward. Except employees absorb enormous operational risks with far weaker legal protections. If the company goes under, employees lose their jobs, their health care, and sometimes their pensions. Suppliers have unpaid receivables. Debt holders have loan covenants. Shareholders have a residual claim, which means in a liquidation, they get whatever is left after literally everyone else is paid. They are last in line legally. The people framed as the primary risk bearers have the weakest legal claim on the assets. The risk bearer argument is exactly backwards. This is the big one. This is the one that gets cited to justify everything. And it's just not true. I looked this up. There is no Delaware statute requiring stock price maximization. None. Delaware courts are almost laughably differential to boards under the business judgment rule. The standard is not, was this the best decision? The standard is, was there any conceivable legitimate business rationale? That is an extraordinarily low bar. You could pour $30 billion into R&D. You could price below profit maximizing levels to build market share. You can turn down a buyout offer. You can increase your wages for everybody by 4,000%. All of it is protected as long as you can articulate a rational business purpose and you are not blatantly self-dealing. The legal obligation to maximize stock price is a fiction. It is a choice dressed up as a mandate. And anyone using it as a justification for a decision is hoping that you don't actually look it up. Fiduciary duty is probably the most abused term in this entire conversation. The actual fiduciary duties in corporate law are narrow and specific. Duty of care, do not be grossly negligent in your decision-making processes. Duty of loyalty, do not put your personal interests above the company's. That is the core of it. Neither of those says anything about stock price. And the business judgment rule exists specifically to give executives enormous latitude within those duties. You can be catastrophically wrong and still have satisfied your fiduciary duty as long as you have made a reasonably informed decision through a reasonable process. Fiduciary duty to shareholders, as a phrase, is already imprecise. Directors owe duty to the corporation, not to shareholders directly in most cases. Fiduciary duty to maximize shareholder value is basically fiction. Fiduciary duty to maximize stock price is just completely made up. It is a real legal concept that has gotten laundered into a fake one through repetition. And here's the thing that nobody says out loud about fiduciary duty. Who employs the CEO? Not the shareholders. The CEO is employed by the corporation. The board hired them. The board represents the corporation as a legal entity, not the shareholders as a class. So, the fiduciary duty runs to the corporation first. The corporation has multiple constitutions. It has actual contractual relationships with employees with employment contracts, suppliers with vendor agreements, debt holders with loan covenants. These are real, enforceable, specific legal claims. The secondary market shareholder has what exactly? A share certificate, some voting rights, and a residual claim after literally everybody else gets paid. That is the weakest possible legal relationship you can have with a corporation, and it got elevated to primary moral obligation somehow. The legal structure has shareholders at the back of every line. The popular narrative has them at the front. Someone invented this on purpose. This is the case. The 1919 Michigan Supreme Court case that gets cited as the legal foundation for shareholder primacy. And the actual facts of this case are something else. The Dodge brothers were minority shareholders in Ford Motor Company. They were also using the Ford dividends to fund the Dodge brothers Motor Company, a direct competitor to Ford. Henry Ford knew this. He knew exactly where the dividend money was going. So, Ford cuts the special dividends. The Dodge brothers sue. And in the resulting opinion, the Michigan court produces some broad language about corporate purpose that gets laundered into a universal doctrine for the next century. But here's what the court also said, and this is documented: the Dodge brothers had a motive entirely outside of their position as minority shareholders. Their own business competed with Ford. Larger dividends would have helped finance their business while draining resources from Ford. The court saw it. They knew what this was. It was a competitor funding dispute, a specific, messy, almost personal conflict between car companies. And Henry Ford, and this is the part that kills me here, Ford got on the stand and gave a speech about wanting to do good for humanity and making cars affordable for the working man. A Harvard law paper later argued that Ford actually had a completely legitimate business rationale, paying workers more and lowering prices to expand market share and solidify a monopoly, but he refused to make that argument because he wanted to monologue about his philosophy. He talked himself into losing. He handed them the case, and the doctrine that has come out of it has been misapplied ever since. If Henry Ford had just said, "I'm investing in labor costs and price reductions to build market share," the business judgment rule covers it completely, and we do not have the conversation for the next 100 years. He just couldn't stop himself from making a speech. And also, great on Ford for talking about the benefits of humanity, considering who he idealized later in life, the mustache man. Here is something that will make your head hurt. Milton Friedman, the guy the entire shareholder primacy doctrine is attributed to, never used the term shareholder value or shareholder primacy anywhere in his famous 1970 New York Times Magazine essay. Those concepts weren't even in common usage in 1970. They got attributed to him retroactively. And the actual argument Friedman was making was much narrower than what gets cited. He was specifically arguing about executives using other people's money to pursue their own political or social agendas without shareholder consent. It's almost an anti-executive power argument. Don't use shareholder capital to run your personal vanity project. That is the real Friedman thesis. CEO, do not buy a private jet with my money. Do not run your social agenda with my capital. That is it. Therefore, maximize stock price every quarter is not in there. The logical jump between don't misuse shareholder capital and optimize for this one specific metric indefinitely is so enormous that you could fit the entire history of corporate maleficence inside of it. And here's the beautiful irony for my left-wing friends who watched this video. That narrow Friedman thesis describes exactly what Elon Musk did when he used Tesla shareholder capital and his Tesla stock as collateral to fund the Twitter acquisition. Tesla shareholders did not vote to fund a social media company. They did not consent to their CEO being a full-time content moderation debate culture war participant. Their capital and their CEO's attention got redirected to a personal project. That is the actual Friedman complaint, not stock price maximization. Don't run your philosophy with someone else's checkbook. Jack Welch spent 20 years at GE becoming the living avatar of shareholder value maximization, the layoffs, the financialization, the relentless quarterly earnings focus. Fortune named him Manager of the Century in 1999. And then in 2009, after the financial crisis, he gave an interview to the Financial Times and called shareholder value the dumbest idea in the world. The guy who made it a religion recanted publicly in a major newspaper. And the GE story is the perfect autopsy of why the doctrine is self-defeating on its own terms. Welch's GE looked incredible on paper for 2 decades. Then his successor, Jeff Immelt, inherited a company that was essentially a highly leveraged financial services firm with some industrial assets attached, completely hollowed out of long-term research and development and investment. The whole thing then slowly disintegrated over the next 20 years. The shareholder value maximization was real in the short term and catastrophic in the long term. They optimized so hard for the metric that they destroyed the underlying business generating the value. The guy who popularized the doctrine watched his own legacy company collapse as a direct consequence of it, and then called it the dumbest idea in the world. The prosecution rests. Okay? Jesus. This one matters because if you have the wrong cause, you will propose the wrong fix, and a lot of people have the wrong cause. The CEO worker pay gap was not primarily caused by shareholder primacy as a philosophy. It was caused by Section 162M of the 1993 Omnibus Budget Reconciliation Act. Congress. Its Section 162M capped the corporate tax deduction for executive cash compensation at $1 million, which sounds like it's reining in executive pay. What it actually did was push compensation into stock options and equity because those were not covered by the cap. So you have a well-intentioned policy trying to limit executive cash salaries, and what it actually produces is a shift to equity compensation, which ties executive incentives directly to stock price, which creates the actual mechanism for the pay gap to explode. Because now the CEO's personal financial interest is in the stock price, and the stock price responds to margin expansion, and margin expansion comes from labor cost. It is a perfect example of a policy producing the exact opposite of its intended effect. The cap on cash compensation did not limit executive pay. It changed the form of it in a way that made it much harder to cap and much more directly extractive. The cause is a 1993 tax provision. It is embarrassingly specific and boring, which is probably why it never gets discussed. Okay, so now you know about 162M, and you're thinking, great, so let's just reverse it. We're gonna pay CEOs less. Here's the problem. First of all, 162M was already resigned in the Tax Cuts and Jobs Act of the 2017 Trump administration, so that's interesting. The compensation structures are already contractually locked in. You cannot unilaterally claw back pay because the tax treatment changed. The contracts exist, the labor law exists, the expectations are set. And if one company dramatically cut executive pay unilaterally, the executives walk into a competitor who has not cut. The labor market for executives has already priced in the equity compensation era. The baseline moved 30 years ago. But here's the part that really kills the just pay them less argument. If every S&P 500 coordinated simultaneously to cut executive compensation, that is the Sherman Act. That is a labor market cartel. That is illegal wage fixing, and it does not get a "but they're really, really rich" exception. The law is structurally indifferent to how sympathetic the victim is. The no poaching agreements in Silicon Valley, Apple, Google, Adobe, Intel, and in the animation industry, Disney, Pixar, Blue Sky, DreamWorks, got hit with massive antitrust action for doing exactly this to engineers and animators. The same legal logic applies upward. So just pay them less requires either illegal coordination or unilateral disarmament. The only mechanism that actually works is legislation that changes the structure for everybody simultaneously, which is what 162M accidentally did in the wrong direction in 1993. Just pay them less is a complete sentence that is not a complete thought. Here is the part of the story that people genuinely miss. The shareholder pressure framing implies that executives are reluctant participants in a system imposed on them from the outside. Poor CEOs! Just trying to run a company, but the shareholders are forcing their hand. That is not what happened. Executives enrolled shareholders into their own projects. They built the equity compensation structure. They tied their personal wealth to stock price. They created the metric, tied their pay to it, and then cited it as an external obligation. Shareholder pressure is CEOs using an abstract, anonymous, diffuse, incoherent class of people as a ventriloquist dummy straw man to say the things that the CEO wanted to say anyway. You cannot interview the shareholders. They do not have a spokesperson. They are a convenient fiction onto which any preference can be projected at any moment. Wins are individual. Losses are shareholder pressure. That asymmetry does not happen by accident. Think about this. When was the last time you heard a CEO invoke shareholder value when announcing something good? We're giving everybody a 15% raise. We are really delivering shareholder value here. We are expanding our benefits package. Shareholders are thrilled. We invested in a 10-year R&D program that just paid off. Our shareholders really wanted this. You have never heard any of those sentences. Not once. The phrase has entirely one job in practice: layoff, justification, infrastructure. It appears when something is being taken from labor and transferred something else. Layoffs, benefit cuts, outsourcing, buybacks. That is the complete operational context for shareholder value. If it were a genuine principle, it would apply symmetrically. It doesn't. The asymmetry is the tell here. Buybacks are framed as returning value to shareholders. Who do they actually benefit? Executives whose compensation is in stock options. A buyback reduces shares outstanding, which mechanically increases earnings per share, which moves the stock price, which moves the option payout. The retail shareholder gets a marginally higher stock price that they can sell into if they want to. The CEO gets a 9-figure option payout triggered by the same mechanism. Returning value to shareholders through buybacks is often just executives voting themselves a raise through a mechanism that sounds like it's for someone else. This is the thing that Milton Friedman was actually warning about. Executives using the shareholder frame to personally enrich themselves while claiming external obligation. The shareholder primary doctrine applied through buybacks often produces outcomes that are nearly the opposite of what the doctrine nominally intends. The Business Roundtable, 181 CEOs, issued a statement in 2019 quietly walking back shareholder primacy in the face of stakeholder capitalism. Think about what that means. If shareholder primacy were a genuine legal and moral obligation, if it were actually mandated by corporate law, you cannot just issue a press release walking it back. 181 CEOs cannot collectively decide to stop following the law because the room changed. The fact that it dissolved is easily the confirmation. It was always just a posture, a rhetorical framework that was useful when it was useful and gets quietly shelved when the political climate shifts. And nobody really interrogated it. Nobody demanded that the CEOs explain how they are going to reconcile their new stakeholder capitalism statements with their existing fiduciary duties. Because everybody, including the people asking the questions, understood implicitly that it was never really doctrine, it was vibes with a Milton Friedman citation attached. A principle that can be abandoned by a press release was never really a principle. This is the original justification for equity compensation. Tie the executives' pay to stock performance, and their interest will align with shareholders. Everybody wins together. Here is what actually happened. Performance-based pay contributed to excessive risk-taking by rewarding short-term stock price expansion. The 2008 financial crisis is partially a story about executives making catastrophically risky bets that looked great for the stock price right up until they didn't. The incentive structure doesn't align interests, it creates a horizon problem. The executive captures the upside during their tenure. They are gone, often with a substance package, before the downside materializes. The shareholders absorb the long-term damage of decisions optimized for short-term price movement. GE 2008. Take your pick. The mechanism that was supposed to solve the principal agent problem created a different and arguably worse version of the same problem. The executive's interest aligned with the stock price. The stock price does not always align with the long-term health of the company. Those are different things, and the ideology treated them as identical. 20 myths, all of them repeated constantly, most of them by people who are genuinely angry about the right things but operating without the mechanism to understand what's actually happening. That is what sloppulism does. It gives you the villain. It does not give you the crime scene, and without the crime scene, you cannot fix anything. The CEO worker pay gap is a 1993 tax provision. The legal obligation to maximize stock price does not exist. Dodge versus Ford was a competitor funding dispute that produced a doctrine almost by accident. Milton Friedman never said what he said. Jack Welch built the temple and told you that it was the dumbest idea in the world. The shareholder is not who you think you are. The obligation is not what you think it is. The cause is not what you think it is. And that matters, because if you don't know the actual mechanism, you end up yelling at an abstraction while the people who keep running the actual machine keep running the same thing. This is TAE, the Art Economist, and I will see you in the next one. Peace out.